Banks regularly publish property forecasts, and the media certainly seems to appreciate the headlines that they create. Yet we know, given the test of time, that they're rarely proven to be accurate, which begs the question, what process do they use to create these forecasts and why do they publish them? This is a conversation that we've been wanting to have for a long time to gain an insight into how the big bank economists come up with their property market forecasts. What are the key inputs? What are the triggers for revision? And what are the implications?
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent, co-host of Foxtel's Location Australia, and author of Auction Ready.
And I'm Chris Bates, mortgage broker. Before we get started, I need to let you know that nothing we say on here can be taken as personal advice. We always recommend you engage the services of a professional.
Don't forget that you can access the transcript for this episode on the website, as well as download our free full or forecaster report, Which Experts Can You Trust to Get It Right? theelephantintheroom.com.au.
We're really honoured to be joined by Felicity Emmett, Senior Economist in the Australian Economics team at ANZ. Felicity has more than 20 years' experience as an economist in financial markets and is now responsible for the analysis and forecasting of key Australian macroeconomic indicators, as well as thematic research on the Australian economy. She also provides specialist analysis on topical issues, including the housing sector and the policy outlook. Thank you so much for joining us today, Felicity.
Oh, thanks very much for having me.
Felicity, thanks so much. I mean, I guess the banking system has lots of assets, and that's people's homes, investment properties, business premises, etc. And we've got lots of liabilities as homeowners as well, mortgages that are also your assets. So why does the property market matter so much to the banks, and why do you produce research, lots of it on forecasting where it's going to go?
This is a good question. Good for a bit of self-reflection as well. So we produce it for a few reasons. One, as you say, is for the bank itself. The bank is heavily invested in housing through its mortgage portfolio, and that is a very large asset for the bank. And so our forecasts help to inform the bank on the risks around that, but also around the outlook around that, and whether price is going up or down, and whether mortgage demand might be strong or weak. So it is very important for the bank itself. But probably even more so is it's for our customers. And those customers might be just general borrowers, like a mum or a dad or whoever buying a home, but also businesses who might be borrowing against their home, or even larger businesses that might be investing in real estate in some form. So across the whole spectrum of bank customers, from very large to very small, they're all very interested in what's happening with housing. Also, I mean, housing does everyone or so many people, everyone needs a home. Many people own their own home, or they want to become a home owner, and it's nearly always the largest share of people's wealth. So people are generally very interested to know where house prices might be going.
I mean, and what do you think some of the difficulties of making it so hard to forecast? I mean, we did a report recently, a fuller forecaster report, and we focused on the banks, and and it's so hard to predict over short time frames, let alone the longer term. And why do you think it's so difficult to forecast where housing's going to be over the next few years?
Look, it is pretty difficult to forecast housing prices. Asset prices forecasting is difficult. Forecasting asset prices is more difficult. And also, I mean, my guess is when you did that sort of study, you're looking over the past few years where we've had sort of extraordinary volatility in the economy, in interest rates, in government spending, and so it has been very difficult, and there have been lots of bad forecasts. I think too, when you go back to the beginning of the pandemic, my guess is this is something that you covered at the beginning of the pandemic, and we're entering into this incredibly unknown period. And in those early days of the pandemic, when unemployment was expected to go well past 10% and stay there for a long time, massive hit to household incomes, there was an expectation, and our international borders closed, there was an expectation that house prices would fall quite sharply. But in the end, for lots of reasons, that didn't eventuate. And so there were very large forecast errors there through the pandemic. But, that really was, to some degree, a function of that incredibly volatile period.
It's actually really interesting that you bring that up, because I think in a way we're sort of getting used to more volatility and more or less certainty generally. And obviously you need an element of certainty and not too much volatility if you're trying to predict anything. We do actually, the Fuller Forecaster Report, we did start them back in 2019 is the first one we did. And so we do them every year, and it's been quite an interesting exercise. And the most recent one we did, we looked at a couple of the banks. I don't think it was actually ANZ. We did NAB and Westpac, I think. And we looked
mainly
back,
NAB, yeah.
We look back 10 years actually, which is quite interesting. But I think that sort of brings into focus for us, and this is where we're really interested into really what's the process that you go through when you're formulating these, because you as a bank, you have access to incredible amount of data and beyond what we would even be thinking to on a global sense as well. And then, of course, particularly with the pandemic, really what actually ended up happening, I think, is that human beings said, I don't like being locked up in this house. I want a bigger one. And honestly, I think that it just comes down to human behaviour is actually what set the 2021 boom. And I don't think economists, correct me if I'm wrong, but I'm not sure if economists spend too much time thinking about how people are going to react on that sort of more individualistic level. So can you run us through sort of in a general sense what that process is? What are the inputs into your forecasting process for the housing market?
You make some really great points there. So hopefully we can come back to some of those ones about your idea that people decided they wanted a bigger home, because that was really important. But when we think about our own forecast, just generally speaking, not in the pandemic, there are lots of things that impact house prices. So we don't adopt a formal model approach here at ANZ, but we certainly do think about what some of the more formal modelling processes do generate. But the things that go into those models and the things that we think about are, things like interest rates, of course, and household incomes and employment are important. What's happening with rents is important. What's happening with inflation at the moment and generally is also important. And then there's sort of any sort of regulatory overlay, and that has been something that's been significant over the past few years. And then there's those odd bod things like, people want a bigger home, and those sorts of things are really very difficult to factor in.
Yeah.
But we might look at what a formal model is producing. So something like some of the RBA research that's been published over the past few years, we'd look at something like that. At the moment, it suggests for every 100 basis points or 1 percentage point increase in the variable mortgage rate, that would take about 8% off real home prices. So we would look at these sorts of things, but, always with models, models sort of look at things and go, well, all else equal, this is the impact of interest rates, say. But nearly always all else is not equal. So we have to sort of, put all those other overlays in to try to think of all the factors that might influence house prices.
Felicity, if I was the CEO of the bank and I wanted to know where my risks were with my assets, right? The general big mass market forecasting that you publish online, and this is what's going to happen to Sydney, Perth, Melbourne house prices, doesn't really interest me that much because it's aggregate sort of data. But if I was sort of the CEO, I'd want to say, okay, well, where do we think we're going to see bigger price falls, right? And what pockets are going to get affected more than other pockets? And how many mortgages have we got in there, And what are we overweight in that sector? Or we got very little exposure to high density apartments in this pocket, for example. So, behind the scenes, is there sort of, I guess, little projects that you work on for the bank, I guess, in terms of helping them understand, debt stress risk? If interest rates go to 6%, where are we likely to see, a high percentage of borrowers unable to meet repayments? Like, is there sort of any insights you can share with us that what the bank does behind the scenes, and where you, I guess, feel like there's, more exposure for you as a bank?
Mm-hmm. Look, from where I sit in the economics area, we really are more interested in the macroeconomic effects of house prices and how that flows through. So, we'll be looking more at how it affects consumer spending, the fall in the house price, that sort of thing. Or, just going back to our forecast, what's driving that forecast? Is it because borrowing capacity is going to be reduced, or is it because we think there's lots of forced sales, something like that? We'd be thinking at it from that perspective. In terms of that minutia and going down and looking at, specific geographic areas and looking at what prices have done there and perhaps what incomes have done and which areas are more perhaps struggling more with income, that sort of thing. We don't really look at that, although there would be parts of the bank that do look at that, and especially in terms of valuations. You would probably remember a few years back when we had a lot of apartments coming on in Melbourne, in the Docklands, and in other areas in Sydney as well. And there were lots of concerns about oversupply in Brisbane as well. And I know that lots of the banks reported that they had specifically had postcode areas where there was an overlay of, risk aversion on those specific postcode areas. So that banks do employ that sort of thing, but that's not the way that we in the economics area look at things. Although one of the things, though, that you said, it is important because while we think about this from an aggregate perspective and how it flows through to consumer spending and dwelling investment in that sort of big picture sense, oftentimes it's not the average borrower that's important. It's that marginal borrower. And that's something that we really do have to think about when we're formulating our forecast, because while most people might be okay, if there is a small percentage that small but important percentage that is going to struggle and perhaps sort of generate some weakness in the housing market where there is an increase in forced sales that then might have some sort of domino effect, then that could be quite important to focus on. We don't think that's the case in this current cycle, but it is important that you think about what that more marginal borrower might be facing.
In your 20 years in this marketplace, have you ever seen that risk, the marginal potentially, creating a snowball?
Well, when we look back to what happened in the US for the global financial crisis, that's really sort of a pretty, one sort of example of that sort of thing. In Australia, we've had such an amazing run with, prior to COVID, 25 years or plus of no recession. And really, when you look at our house price cycles, it's not correct to say house prices never fall, but the declines have been really quite shallow, and they haven't generated any sort of significant increase in arrears, really, or in forced sales. In Australia, in the sort of mortgage market that we have, this full recourse mortgage market, people do tend to hang on to their homes. Yep. It's the very last thing that they give up. They'd rather have Vegemite sandwiches for dinner and pull their kids out of private school than not pay their mortgage. So what we tend to see in Australia is an extended period of, slowly falling house prices or flat house prices after a big boom rather than a big crash. And that is part of the framework of our mortgage system here. Really helps to cushion, in a way, the blow.
I think that's a really big point, to be honest, because a lot of sort of level one thinking, I would call it, with people who are looking at the property market. A lot of people want the property market to come down so it's more affordable so they can buy. And that in itself is one of the things that protects the market, because as prices fall, more people want to buy, right? And want to upgrade or enter the market. But a lot of people think, oh, okay, all of a sudden interest rates are going up, which they've gone up really only in the last 3 months, right? They've been at 2%, now they're at 3%, right? Or maybe up to 4%. But the debt stress, even if you are, you don't, that additional payment is forcing you to be a bit tighter with your money. You don't all of a sudden go and put your property on the market, right? It takes many months and sometimes years for you to really, before you start to use all your buffers or once you speak to the bank, etc. So is that what you think, even though rates are likely to go up, we're very unlikely to see any real significant debt stress, because people will make cutbacks to their spending, and we're unlikely to see any real massive forced sales across the country?
Yeah, look, that is definitely our view. I mean, the reason prices will fall is because there's reduced borrowing capacity.
Yep.
I mean, we expect the cash rate to go to 3.35% by the end of this year. The RBA is sort of factoring into its assumptions a rise of 3 percentage points. And if you look, that sort of increase in the cash rate reduces borrowing capacity by between 25 and 30%. It's quite significant.
Massive.
For the same sort of repayment. And so that is the main reason why we expect prices to fall. It is, that people have these very large buffers. We know that there's been this massive build-up in savings, some in offset accounts, some just in normal deposits, 260 billion through the pandemic. But even before the pandemic, all through the period of falling interest rates from sort of 2010 onwards, people actually were increasing their liquidity buffers, essentially putting money in the bank. And when you look back, it seems as though it was really sort of a bit of a making hay while the sun shines, and people realised that this period of low rates could be temporary. So we know that people have these buffers. We actually know that even that across income distributions, there have been improvements in people's buffers. When we look at debt distribution, we know that people with more debt have increased their buffers more. So all of these things will really help to keep households in a good position as interest rates rise. I mean, another thing that really influences arrears is when people get into negative equity. But because we've had this big run-up in prices, not everyone has got in at the top, obviously. And because also the banks actually, even though there has been an increase in high DTI, debt-to-income lending, there has actually been a reduction in lending with high loan-to-valuation ratios. And so what that means is that actually very few people are in negative equity now. The RBA estimates there's 0.1% of loans are in negative equity. If house prices fall 10%, they think that might go to 0.4% of people. And if house prices fall 20%, they think that might rise by as much as 2.5%. Now, is still, not immaterial, but in 2019, negative equity peaked at about 3.25%. So it's still lower than 2019. So that really means that people are really coming into this period of higher interest rates in a very solid position. It doesn't mean that people can keep spending the way they have been, that they will have to spend less and spending will slow. But that is the intended impact of higher interest rates.
I've got two questions from that. And one is, I guess, because our spending isn't necessarily discretionary. I mean, obviously, the well-publicised iceberg lettuce at $10. I mean, I bought capsicum the other day, $16 a kilo, for God's sake, you know, and it is really obvious. At first, when people were talking about rising food prices, I was like, well, I can't even really see it, but I certainly can now. It's very, very plain. So a lot of this sort of inflationary pressure isn't necessarily in our control as consumers, whereas previously, maybe you could argue the more of it was. And yet, obviously raising interest rates or increasing interest rates is designed to sort of put downward pressure on inflation. So how will this be impacted? How will, I guess, inflation be impacted with this round of rate hikes as compared to previous ones?
Okay, so just a couple of things picking up on some of the things you said. Already, even inflation itself is going to have a downward place downward pressure on spending. And going to your point about discretionary and non-discretionary, what we've seen is prices for non-discretionary items rise at a faster rate. And so that means there's less money to spend on those discretionary items. Interestingly, though, people are still really continuing to spend at a pretty solid rate. So, as you know, the banks collect data on what people spend and what businesses, what's coming through on the terminals. And, when we look at that data, which, we've got it right up now until early August, you can see that people are actually still spending at a pretty solid clip. And they are still spending on discretionary items. They're still spending on big ticket items. So there doesn't seem to be any impact as yet. And when we look at New Zealand, obviously we have a fairly big operation there. Now, they have seen interest rates hikes since October last year. And again, we're not seeing in our spending data any real slowdown in spending data there, even though they've had much higher interest rates. So that is sort of interesting, I think, to see. But the way that interest rates, that they have a few channels that they work through. The main one is this cash flow channel, and that just means that people have to divert more of their income to mortgage repayments, so they have less to spend money on discretionary items. The other way it works is through the wealth effect, that people won't feel as well off because they won't feel that their home is worth so much. They'll see a home sell around the corner and think, oh, I thought that would have been worth more than that. And then they readjust their own expectations of what they're worth. And that flows through to consumer spending as well. And then we start to see that impacting on things like building approvals and how much people spend on building a new home or buying an apartment or doing renovations. You're much less likely to spend a truckload on a big renovation if you think your home's not worth as much. So it flows through in all sorts of different ways. The difference about this cycle is that we haven't had inflation this high since the early 1990s. Putting aside the period of the GFC, we just haven't had this problem for 30 years. And so it is a bit different. And that, I think, means that it creates a lot more uncertainty around forecasts. It creates more uncertainty for the RBA in calibrating its policy and working out, look, at what point do we stop doing 50 basis points and we move to 25? And at what point do we stop hiking? And it does create the environment where there is a possibility that they make a policy error, and they might not tighten enough, and they might find that inflation keeps getting away from them, and then they have to tighten very hard. Or they might come down too hard, and then we find the economy goes into recession. So it is a very, as Phil Lowe called it, a very narrow path through here, where they tighten at just the right pace to keep the economy on relatively solid ground, but get inflation under control.
Yeah, you talk about consumer confidence or spending, which you haven't said confidence, but it's sort of part and parcel, isn't it? Because what we've seen, certainly anecdotally around the property market, and certainly you can see that in terms of the price growth slowing and moving into price falls in some areas, is that the consumer confidence in the property market has certainly taken a hit. And you can see that also in listings numbers. There's obviously a lot less property coming onto the market. And yet what you're saying is that haven't actually hasn't manifested in discretionary spending. It's not like we're lacking confidence in that area. Is that a dichotomy that hasn't really shown up before? It sounds unusual.
It is really unusual. That's exactly right. So I mean, you're right in terms of confidence in the property market. When we look at some of the indicators that come out of the Melbourne Institute in terms of consumers' expectations around house prices or their idea of when is a good time to buy, they are really quite low. They've come back a long way. And so that confidence in the property market is low. But generally speaking, consumer confidence is very low. It's at recession levels. Today in the ANZ Roy Morgan release that showed weekly consumer confidence fell 4.5% or so. It's down to the levels that it was in April 2020, when the worst of the pandemic was hitting, and there was so much uncertainty. And generally, it's at recession levels. This is something actually that we're seeing around the world, that confidence is very, very low at the moment. And this is impacted by a couple of things. Firstly, by inflation being so high, and that, especially petrol prices, you get a lot of sticker shock from petrol prices because people, they see the numbers up there, they fill up their tank once a week, and it's very apparent how much extra is going into petrol prices. So that was really, and food prices as well, that we've seen because of some global issues, but of a lot of local issues, including, around lettuces and the floods, and that has really flowed through to consumer confidence. And now that we've got interest rate hikes coming through and the prospect of quite significant interest rate hikes, that is really starting to impact consumer confidence as well. And we can see a split of consumers on whether they have a mortgage or whether they rent, and consumer confidence for people who have a mortgage has fallen very sharply since April, when it became apparent that the RBA would have to start hiking. We've seen that fall somewhere, sort of around 30%. Whereas for renters, it's only down quite modestly. So we're definitely seeing that with confidence. But as I said before, spending has actually been quite solid, and we will get the full consumer spending numbers for the June quarter in 3 or 4 weeks. But it looks like at this stage it will actually be quite solid for the quarter. And as I said, our ANZ data show that it's still staying quite high even currently. And this really large divergence is incredibly unusual. And again, it creates that uncertainty. Well, what will happen? Will confidence recover as people realise that they can manage these high repayments, or will actually we just see spending, come down quite quickly to be more consistent with consumer confidence?
Felicity, is that why you think that they're going to have to go? A lot of other people aren't forecasting rates to go as high as you guys. I mean, in terms of 3.35 by the end of this, by Christmas, really, which is basically another 3, September, October, November. So 50 basis points. Which is a pretty big tightening, right? To go from 0.1 to 3 plus within, basically 6 months is massive. And do you think this because consumers aren't cutting back their spending? I think that's really interesting. In New Zealand, they haven't done it. I mean, it's quite soon here. We're only talking 3 months since the first rate hike, or 4 months, I guess you'd call it now. But is that why you think? Also, there's so many loans at fixed rates. That's not impacting them. Their variable portion, but that's for a lot of people who fixed the last few years. They've been fixing 80% of their loans. So, what's some of your reasons why you think they're going to go so hard? Because that's pretty big compared to other expectations.
If you like what you're hearing here, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars, please. Every review helps make it easier for other people to find us and hear what our amazing guests have to say. We love hearing your questions and we're planning more listener Q&A episodes. Please send your questions in. You can send them via the website, which is theelephantintheroom.com.au, or directly via email to questions@theelephantintheroom.com.au.
Look, it is really steep. It will be the steepest increase in interest rates that we've seen, certainly in the inflation targeting period of the last 30 years. And we are one of the more aggressive banks, although the market is expecting interest rates to go a little higher, about 3.5% by early next year. So we're not quite as aggressive as the market.
Yeah.
And you'd remember that the market actually had above 4 there for a little while, and it's brought those expectations back. So it is an aggressive rate profile, and there is certainly the risk that they take a little bit longer to get there than we currently expect. But when we look at the inflation numbers that we had a couple of weeks back, headline inflation at 6.1%, underlying inflation trimmed mean that the RBA focuses on at 4.9%. They're the highest rates that we've had for 30 years. So the RBA has a really big job to get on top of it. Now, lots of the drivers of inflation have been global, but actually there is a lot of domestic pressure now. You can see it in how broad-based those inflationary pressures are. So around 80% of the CPI basket is rising at faster than 2.5%, the middle of the RBA's target. And you can see it in the tightness of the labour market. You've got the labour market unemployment at 3.5%. You've got around 500,000 job vacancies that really suggest that unemployment is going to get quite a bit lower. We think it will get to sort of 2.9% by early next year. So that really tight labour market and more generally the capacity constraints in the economy is likely to continue to generate pretty solid inflation. We might be past the peak in quarterly inflation, but it's still going to stay quite strong because of this very strong demand, very strong labour market. And so that means that the RBA has quite a bit of a job ahead to get on top of that, to make sure those inflation expectations don't become really ingrained and we do start to see some sort of wage inflation spiral.
Yeah, I mean, that's what I was going to ask about. I mean, do you think that's really the main reason why it's so important that we get inflation down? Because if we're expecting inflation to stay at 5% per year, then as a worker, why wouldn't you ask for at least a 5% pay rise? And and then you have to put prices up because you're going to have to pay more wages. Do you think that's the real risk, the tight line that we're playing right now? If we keep inflation high for too long, we really get ourselves in this catch-22.
Yeah, that's exactly right. That is the concern. And I mean, it's perfectly reasonable for workers to feel like they want compensation for higher inflation. And really, we've had a long period of, low or negative real wage growth. I think it's reasonable for workers to expect that. But it does raise the risk that if we continue to get this compensation year after year of the high inflation, that we will get this wage price spiral. But also, it's probably not just about compensation for that risk. A lot of the wage gains that we're seeing are for people who are on sort of contracts. They're not so much minimum wage earners, although obviously this year they did get a solid rise. They're not people on EBAs, they're people on contracts, and they're getting quite large wage rises, and that's what's captured in the wage price index. But probably they're even larger for people who are moving jobs or people getting promoted. That's not even captured in that particular wage measure, and that's probably because the labour market is so tight.
I mean, do you think around housing affordability, a lot of people would think houses are getting cheaper, but are they really getting cheaper if your servicing costs are going up a lot more, right? So if you're paying 30% more each month for the next 30 years, and that's not the way it works, but if your mortgage repayment is higher, but that's greater than the saving on paying for a lower price. I mean, housing getting more expensive right now, do you think, rather than cheaper?
Yeah, no, this is a really great question, Chris. And this is something that is, we do think about. And the answer is sort of, it depends, a typical economist answer. But pretty much it's not really getting cheaper. We had a look at this with our housing affordability report that we do with CoreLogic, and we had a look at how much the increase in repayments would be because of interest rates and how far house prices would have to fall to offset that. Now, at the time we did that, I think we factored in 200 basis points of interest rate hikes, so less than what we've got at the moment. And we really found that house prices would have to fall more than 30% to compensate for that.
Yeah.
So it doesn't make it affordable in that mortgage servicing sense. But we do know, though, for first home buyers, the mortgage servicing hurdle is not as great as the deposit hurdle. That is really the thing that stops first home buyers getting into the market, and lower house prices will impact that deposit hurdle. So for some, they can get in, as you say, or as you sort of implied, those higher rates are not necessarily going to stay forever. So mortgage servicing might be difficult initially, but they will have that slightly lower or materially lower in dollars terms deposit that's required if we do see house prices come off 15% or so.
Yeah, the deposit hurdle is a funny one. A lot of people use 20%. Why do you think it's 20%? I mean, really, you could get into the housing market with a small deposit. That maybe 15%, I think, is a better number. 10% for deposit, 5% for stamp duty. I mean, a lot of banks go for that 20% deposit. I mean, why do you think that is?
I think, well, now we have the government scheme where you can get in with 5%. But I think, traditionally, if you had less than 20%, you had to pay mortgage insurance, and that just increased the cost. So oftentimes when we're looking at things like deposit affordability, we do base it on that 20%. But you're right, most people that do enter the market, they don't have that 20%. It's considerably less than that. But it still is quite a significant hurdle for first home buyers. And when you look at the Sydney market, for example, and median prices here, it's a lot for, I think on the latest affordability, saving up for a home in Sydney, on average, if you save 15% of your income each year, it's going to take, I think it was somewhere more than 12 years. So it's just sort of outrageous, really.
Yeah, I mean, that's something that government's looking to change with stamp duty moving to land tax, which we might find out, in the next few months, whether that gets legislated. I mean, things like that, how do you, as an economist, because you can't forecast that, right? They've talked about that for a couple of years, but this is a once-in-generation change. You could see APRA come out, I know in the Bank of England, just overnight, they basically reduced the buffer for mortgages over there massively. They went from a 3% servicing buffer to a 1% servicing buffer, which is something that APRA could do here. I mean, why do we need a 3% buffer if rates have just gone up 3%? They're unlikely to go up 6%, right? How do you sort of, and it's so tempting for the government to, try to fiddle with things because of all the impacts on the wealth effect and, household balance sheets and how healthy, financially healthy we are going to retirement, etc. So what's your thoughts around these other, factors that it's just so hard to put into your model, which are bound to happen as prices change, whether it's tightening or loosening, it's bound to happen.
Yeah, no, this is, again, really great question. And it is very difficult to quantify the impact of those regulatory changes. Yeah. I mean, you'd remember in that period between 2017 and 2019 where house prices fell quite substantially. And that was really all about, some official regulatory changes that APRA introduced, but also about just a general change in appetite for risk around lending post the Royal Commission into banking. And, so those things are incredibly difficult to quantify. But to your point around the buffer, I think there is quite a strong possibility that at some point APRA will reduce that 3% buffer. I mean, it doesn't really make sense at a cash rate of 3.35 and mortgage rates, at 6 or above, to have a 3% buffer. And also, it will unnecessarily slow the housing market. So I think, that they'll have to come to that decision at some point to lower that buffer and perhaps put some systems in place to have, make sure it is counter-cyclical and that they're not it's not overly constraining on the housing market. But that sort of thing will make a difference because, as I said before, it's borrowing capacity that's going to be the biggest influence, and that if they change that serviceability buffer, then it changes the borrowing capacity.
Yeah, I mean, what we're sort of seeing with borrowing capacity, borrowing capacity's fallen, 15, 20% for lots of people. You could probably borrow 6.5, even up to 7 times for a lot of clients. Now we're talking 5 to 5.5 times income, which is huge. I mean, but that's assuming no wage increase. It's assuming that, APRA don't come, and if you get a 10% increase in your salary, then you have 10% increase in your borrowing capacity. Think about it that way. And, we could see APRA reduce the serviceability buffer, which could increase borrowing capacity. And, there's even talk that rates could come back down, etc. So what's your thoughts on, there's one line of thought that the RBA is going to over-tighten to get inflation under control, which is going to slow down world economies. Then we're going to see a lot of people jump off fixed rates and a big cutback to spending, etc. And then there's pressure to reduce rates. Do you think that that's the most likely scenario over the next few years, is that they get over-tightened around the world, then they get loosened to stimulate economies post a slowdown?
This is part of the forecasting process, and certainly in the US, where inflation is higher than it is here, but we are catching up quite quickly. They have said that they might really have to engineer a hard landing, essentially a recession, to get inflation under control, and that would mean ramping up the Fed funds rate there. More quickly and more steeply, knowing that it will only be very high for a short time and then they'll cut. And that's certainly a possibility there. Here, I think that inflation is not as well entrenched here. We don't yet have the wages pressure that is apparent in some of those other economies like New Zealand and the US and the UK, although it does feel like it's coming. So our view is that they will be able to sort of navigate a soft landing. And also, we think that inflationary pressures will be quite sustained and what we call sticky. It'll take a little while for them to fade materially. Some of the things like petrol prices, they're already coming off. The oil price might go back up a little bit more from where it is now. And we've got the excise, jumping up 22 cents later on in the year. But it's unlikely that the oil price will get back to $125 where it was. So some of these things are coming out. But then at the same time, we know that wages pressures are increasing. So we think that inflation will be relatively slow to fade enough for the Reserve Bank to cut rates. But 3.35, in our view, is restrictive, and so eventually they will cut rates, but we think it will take sort of till the middle of 2024 before they start doing that, because before then inflation is likely to be too high for them to feel confident to reduce rates.
So it's been over 30 years since we had a real recession. You don't really count 2020. Who's the most vulnerable? Are property owners really in the most vulnerable cohort of a recession, or is it people that don't own property?
Look, that's a good question. We know that renters are actually doing it pretty tough at the moment. Advertised rents are up nearly 10% over the past year, and there's not a lot of rental stock, so rentals are really tough. And we know that particularly older people who rent are incredibly vulnerable
Yeah.
to the risk of poverty and homelessness. So those people definitely are vulnerable. I think, when you're thinking about a recession, the thing that really impacts people's lives are the loss of a job. And whether you own your own home or you rent your home, losing your job has massive impacts, obviously, on your income and livelihood, and not just temporarily. Often those impacts, can affect the rest of your working life. So if you're a young person, that impact, we can see it in studies, it will impact your income throughout your life. And so it's really the people who lose their jobs. I don't think that there's when you look across housing status, whether you rent or own home or have a mortgage, it's you can really differentiate. But if you hang on to your job, then that's the thing I think that really counts in a recession, and that's why central banks always try to avoid recessions, because the long run impacts of unemployment are massive on an economy scale, but also on a human scale.
I mean, looking back at the last few years and all the stimulus that was pounded into the market in 2020, do you think that the central banks and the governments around the world overstimulated things and put too much wood on the fire, I guess, and that's why we're in the situation we're in? They all kind of drank the Kool-Aid and, thought the world was going to end and put too much on there?
Look, the short answer to that is yes. We saw massive interest rate cuts. We saw extraordinary policy like the yield curve control and quantitative easing and the term funding facility. And we saw also the government around the world and government in Australia step in to support household incomes while people couldn't go to work. And the combination of all that has created this, a situation of excess demand. However, when we roll back to where we were in April 2020 and the uncertainty and as I was just saying before, the costs of very high unemployment, I think that policymakers, did what they thought they should. And when we look back, it's like taking out insurance. And sure, when you take out insurance and you don't need to claim on it, you go, yeah, maybe I didn't need it. But, you take that insurance, I think. And I think, so I think that with hindsight, we can see it was too much. But at the time, I think it's really hard to be super critical of either the Reserve Bank or the government, because, they were insuring against a really terrible, a possible terrible outcome. And so, I think in the end, you've got unemployment at the moment at 3.5%. It's generating some inflation pressures, but, nearly everyone who wants a job has got a job, and that is a good thing.
And do you think that once, for example, you're expecting house prices to fall, some percent over the next, year or two, when do you think that the governments and the banks will be worried that there is a systemic risk, or do you think that we are going to see things like APRA cut the rate? What other stimulus measures do you think they're going to do to try to support prices to stabilise and then increase, I guess?
Well, so they do. The RBA is not, and APRA, the regulator, is not going to be too worried if house prices sort of fall in a relatively orderly fashion. They will, that is part of the way that monetary policy works. So APRA is unlikely to come out and cut the buffer in the next couple of months, because that would be working against what the RBA is trying to do. I think that they will be watching the real economic indicators, things like household spending, to see how the wealth effect is impacting that, and also that cash flow impact. So I think that if we see this sort of relatively gradual decline in house prices, it's the sort of thing that we're seeing in New Zealand, where they are ahead on the interest rate cycle. I think that policymakers will be, quite happy to see that, really, because that's the way policy works. I think when it becomes problematic is when, if you started to see perhaps a significant increase in arrears or a significant signs of distress in the mortgage market, and when then it might become sort of a financial stability issue, or you start to see it really impacting consumer spending. And that's when I think the Reserve Bank might think about hiking, so that's how that would play out. In terms of the buffer, I think that's probably something for next year. Once the RBA gets policy to where they think it is, and then perhaps next year sometime, APRA might start to cut the buffer. But it's too early now, because it would be, as I say, working in the opposite direction to the RBA's intentions.
I guess by explaining all this for us, and really appreciate this, it's spelling it out for me, I guess, again, why it's so difficult to forecast, because you've got all these other regulatory forces that can play around with the market to keep it in one direction or another. So it's obviously a big part of our entire economy, and the property market is so important for that. But it's funny, you mentioned earlier about, over the past few decades when we've had downturns, they've been relatively shallow. But I do remember the 2017 to 2019 decline. That was quite steep. And, there were lots of this sort of catching a falling knife as one of the analogies that was used quite often. And I guess we look to this one and see, well, how will this one play out? But, and my favorite thing to say at the moment is that they're never bottomless. They'll bottom at some point, and then they'll go off again. It'll be another part of the cycle. But what's sort of interesting as well is that, particularly 2017 to 19, well, that was, like you said, it was after the Royal Commission, and APRA obviously saw the need to really curtail the market, because it was obviously over-exuberance among investors' participation in the property market. And those two things coincided to effectively mean that nobody was going to change the levers around. No one was going to play with it in a way that would actually make that downturn a bit less steep, shall we say.
Mm-hmm.
Would you say that, you might disagree with my assessment of that, but would you say that in the current environment, there's probably more of a capacity or more a willingness to actually keep it being shallow rather than being as sort of steep and seemingly precarious last time around?
Yeah, I think that in that period then, 2017, 2019, I mean, that's a period, that when we look back, APRA, there was APRA and the Royal Commission that impacted housing lending, but also there's certainly a relatively strong view that interest rates were kept too high through that period.
Mm-hmm.
I mean, this is part of the RBA review that's coming up, and they will look at that. I mean, the Reserve Bank was missing its inflation target through all that period. So effectively, unemployment was higher than it could have been. So there were, I think, a number of factors through that period that actually, in retrospect, perhaps could have been different. And I think, too, there was perhaps not a full appreciation of the indirect impact that the Banking Royal Commission had on lending appetite at the banks. I think this time round, though, it's a bit different. I think the RBA wants, it needs to see activity slowing, and part of that process is lower house prices. The RBA is not going to be concerned by what we've seen so far in house prices, and it's going to be expecting house prices to fall quite considerably. As I said before, its modelling would suggest that house prices will fall around 25%, given on a 300 basis point increase in the cash rate. And so it will be factoring that into its forecasts and thinking about how that's going to impact consumer spending and dwelling investment and financial stability. But it will certainly be expecting house prices to fall. So I don't subscribe to the view that the RBA will feel like it needs to step in to stop house prices falling because, the banks are in really good shape. Households are in really good shape. Arrears are very, very low. So there isn't sort of a financial stability issue. And I think that people will keep spending because they're generally household balance sheets and buffers are in really good shape. So I can't see them stepping in to stop things just yet. I think they've got a little while to go. But just going back to the issue around fixed rates, that does create a bit more uncertainty because there are these people at the moment who are sort of insulated. Some of those people will be, quickly putting a bit more money away and thinking about where they can cut spending. But there's probably a proportion of people that perhaps aren't as financially sophisticated that will get a shock sometime in the next 18 months or so when they have to roll on to much higher repayments. And that will be a tricky period.
Yeah, I mean, I think what's happening with interest rates are very much tied to your mortgage repayment, but your mortgage repayment isn't just interest rates. It's, how much do you actually owe, right? And can you extend your loan term? And can you get yourself a better rate, like a better margin, a lower margin? Interest rates could go up, but you could go to a different bank and save yourself 50 basis points. And what we're seeing, and you can already see it through, digital channels, when you're driving around, bank advertising, etc. There's a full-on pricing war between all the banks to not lose their customers, to other banks. And, as people come off their fixed rates, it's really a time for them to go, you know what, maybe we should review our mortgage. And there's even things where, potentially in the next 6 to 12 months, you'll be able to refinance without any servicing checks. The banks are basically saying, well, if you can pay your mortgage off and you haven't been missing repayments and that repayment is higher than what this new repayment's going to be, we don't need to verify income and things like that. So there's this. I think that's what something is forgotten about with rising interest rates. If you just go and extend your loan term 10 years and get yourself a better deal, that offsets the impact of a higher interest rate dramatically. And that's exactly what people are doing right now. So making it even harder for the RBA and slowing down spending even less because people are saving money that way. So Felicity, on a lighter note, have you got a property Dumbo for us, a story that our listeners can learn from?
Sure. Now, so I do have one. It's quite funny, actually, and I'm complicit in it. So it's not like I can tell some story about someone else doing something stupid.
These are the best ones.
So this was, but it's actually, sort of a good story. So a friend of mine was selling the family home and sort of downsizing into an apartment. This is sort of 10 years or so ago. And she found this apartment on sort of the lower North Shore. And, she said, come and have a look at it with me. And we looked at it. And, she was really focused on her requirements. She wanted a fair bit of space. She had 2 teenage kids and she wanted large rooms. She wanted it to be light. And so we looked at all these things. It was this lovely apartment that, it faced south, but it was very light. It was an Art Deco apartment. It was lovely, ticked all the boxes. And so, I said, this is great. She really liked it. So she went for it. She got it. And then the day she moved in, she sent me a photo and she said, look at this. She had these magnificent views of the harbour that we literally did not notice. I know, it's unbelievable. I wouldn't believe it if it was anyone else, but I was there. I was part of this story. We did not notice the harbour views.
Wow.
That's hilarious.
I guess that's a great result. That's not a property dump. I mean, I guess it's a dump. You didn't know. You probably paid for the views.
Could have been the other way around. Could have been something horrible they didn't notice.
That's right. That's right. Yeah. But it just really goes to show, you got to be focused on everything and not just on your, it was too much of a ticker box and not the big picture.
Oh, it's so funny. We've just upgraded and yesterday we went just to suss out actually how to put a cat pen at this new house, and where our furniture is going to go and what we need to get rid of, etc. And it's a completely different experience, and you're looking at different things, and it feels completely different to before you purchased it, right? And both positives and negatives. You're noticing parts of the house that you didn't notice. You look in areas, you look at it differently when it's yours versus more critical, I guess, to be honest. When you're looking to buy, you probably sometimes you just want it to make it happen, right? And you're looking at it through rose-colored glasses, and so. That's why, Veronica, you'd recommend someone to see it at least more than once if you can, if not, and at different times of the day, etc. Because it's so easy to miss things when you're emotional, and you're sort of, and sometimes people are going through open homes in 10 minutes and making offers. It's like, and not even looking over the back fence, etc. So I completely understand why you guys didn't see the view, but. Yeah, hopefully the view's still there and nothing's been built out in front of it. But yeah,
still there, and she's still there. So 10 years later.
Yeah, that's a nice.
And hopefully she's not doing the opportunity cost of maybe the house on the lower North Shore versus the apartment, and where she could have been if she just stayed in the house.
Maybe.
Yeah,
I reckon an Art Deco apartment with a 3-bed. I think she's done all right. Yeah,
I think she's probably done all right. Yeah, exactly.
Felicity,
doesn't sound much of a downsize anyway.
We've really appreciated your time and taking us through all this stuff. It's been a really fascinating conversation. Hopefully we can get you back at some future time. And thank you. It's been, for ages, I really wanted to grab a bank economist and sort of get to the nitty gritty of all the things that are considered. I'm sure we've only scratched the surface, but it's been a great chat.
Oh, no, thanks very much for having me. It's been great to chat to you guys as well and hear your, the way that you think about things. So thank you.
Awesome. Thank you so much.
If you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or North Shore, my team and I can help you buy without regrets. Reach out via my website, gooddeeds.com.au.
If you're looking to buy your first home, thinking of upgrading into a new one, or purchasing an investment property anywhere in Australia, my team love to carefully guide you on this journey. And most importantly, get the finance right. Reach out via our website, wealthful.com.au.
Thanks for joining us. We'd love to see you again.
And remember, don't be a Dumbo.